I just won this trade for $9,000 and this trade for $20,000 live with my #1 trading strategy, supply and demand. I know you've heard it 100 times. If there's too much supply, price is going down, and if there's too much demand, price is going up. So today I'm going to give you a complete course showing you how I draw supply and demand zones perfectly, which zones will hold and make you the most money, where to target all your profits, how to use momentum like a professional trader, and all my personal secrets. I promise this video will simply make you a better supply and demand trader. Just smash the like button, subscribe to the channel, and bookmark this video because it's going to change the way you trade supply and demand forever. Now, let's make some money. All right, here is my most recent back test of the supply and demand strategy. You can see an 85% win rate, a P&L of over 4,500% on a 100 trade back test. And if we go into my FX book account, you can see here this is a real verified trading account, up $29,000 on a couple of trading days using supply and demand. And as I scroll down here, you can see all of the positions I took, banking me over $10,000 on this gold sell position and $9,000 on this Australian dollar Japanese yen trade. If we go right into that Japanese yen trade, you could see we had momentum slowing right here. We had the price enter into my demand zone right here, and then I placed a buy trade which shot up and smashed my take profit at this level right here for $9,000. Now that may look simple, but there's a ton of different rules that go into this exact trade, and I'm going to teach you all of that now so you can start winning trades and making money with supply and demand. All right, so I'm just going to give you the basics here. You can see we have an uptrend here, we have a downtrend here. When the price pushes out of an area like this or out of an area like this, we're getting a lot of buying pressure or selling pressure. When we get a move that's this large, that buying pressure or selling pressure is coming from big institutions, smart money. That's creating our demand zone at that area and our supply zone at that area. Because we have the institutional buyers pushing the market from this price and the institutional sellers pushing the market from this price, it tells us it's a good price. So if the price ever comes back down to that area, that's an area of demand or an area of supply that we're obviously interested in placing a trade from. So we would be buying from here, we would be selling from here, because that's what the big players in the market are doing. Now let's get into the actual charts to show you real live examples. So the first thing we're looking at here is the uptrend, right? We're clearly in an uptrend right here. If you struggle with market structure, you can always use an EMA. That's a moving average exponential. You could just click on that, put that on your chart right there. I have this set at the length of 200, and you can see here if we are above this line right here, we are clearly in an uptrend, which means we're only looking for demand zones. How do I draw those demand zones? How do I draw those supply zones? It's really quite simple. What I'm looking for is 4 large green candles. 1, 2, 3, 4. I want to see that in a row. Then I'm drawing my demand zone from the first red candle before the big green push up. That becomes my demand zone. We want this to be a big impulsive move because that's how we know those institutional buyers are in the market. Now, it's not required, but if you have a level of support or resistance, like a level right here, this makes it an even stronger trade. You can see this level here was used as resistance and also used as support. So that's combining your demand zone with some basic support and resistance. It's more likely to hold. On a valid demand zone, we also want to have a break of structure like we have right here. If you have the price up here coming down like this and then coming up and it doesn't break this level right here, you're not getting a clean break of structure, which makes the demand zone weaker and less likely to hold. You also want to create a fair value gap. This is a basic 3 candle pattern. You can see we have candle 1, candle 2, candle 3. Now, what we want to see is a gap in the market. You could see right here, there is a gap. This is because this candle right here does not fill the gap, and this candle right here does not fill the gap. What this is telling us is there's a market imbalance, right? When the price shoots up very aggressively, you want to create at least one strong fair value gap like this, one market imbalance. That's telling us that it's a strong demand zone again. So let's just play this out, and you can see here the market is starting to move, and we're waiting for the price to come back to the demand zone. When the price comes to the demand zone, it taps in and the price shoots up. That is a really good sign. Price comes back to the demand zone, shoots up again. This is giving you multiple trading opportunities from the exact same demand zone. And every single one of these is a worthy trade. This one is your largest trade for about 100 pips. Even this move here is 50 pips. This move here is 40 pips. Every single one of those moves could have been a solid trade taken from the demand zone, because the institutional traders are telling us that this area is a good price because all of the rules and conditions are met, which make this a strong demand zone. Now, what if we have a weak demand zone? Well, you could see here we have the price pushing up, right? I'm going to target the last red candle here before the move up. That's our demand zone right there. If you look at this trade, it's not too bad, right? Our support level is a little bit further down here. Ideally, you want your support to be right there. We do get our break of structure at this level here, but we're not getting a huge impulsive move up here. These two red candles right here are showing market indecision. It means there's actually some sellers at this level pushing the price down quite significantly. So this is a weaker demand zone. If you play the trade out right here, you can see we did get a fair value gap at this level right here, and another fair value gap at this level right here. But these red candles in the middle here are really making this a weak demand zone. And because of that, when the price comes down, the price is actually going to slam right through. If we look at this area right here, we do have slowing momentum, which isn't bad. But then we get a huge candle right here, which is scary as this comes towards your demand zone. And obviously, it's no surprise it's a weak demand zone and the demand zone is broken. If you put the 200 period moving average on the chart here, you can also see here that we don't have a clear trend, right? When the price is coming up against the moving average, breaking through the moving average, and kind of going back and forth through that moving average, it's a choppy market, and supply and demand zone trading works better in uptrends and downtrends in consistent markets. It's important you know that market structure. Now let's look at a supply zone example here. What's going on? Well, we're clearly in that downtrend, right? If we put the EMA on the chart right here, you can see the EMA is telling us we are in that downtrend, right? Price is below the 200 period moving average. So we're looking for those supply zone setups. We had support turn into resistance here. So that's a strong area. And then what are we seeing right here? We're seeing a lot of red candles. We're seeing a strong impulsive move to the downside. We're getting our fair value gaps right here. There's one. We have another fair value gap right here. Another fair value gap right here. Another fair value gap right here. So this move is so impulsive, it's creating 4 fair value gaps. And what did I say before? I said before that I only need to see 4 red candles in a row. Here we have 1, 2, 3, 4, 5, 6 red candles in a row. This is clearly a strong supply zone. Where am I setting that supply zone from? I'm setting it from the last green candle before the push down. So this right here is that green candle. And then I'm going to swing my supply zone over like this, and I can extend this as far as I want and continue to use that as long as we stay in this downtrend, which it looks like we will, because you can see here the market structure. We're clearly below the 200 period moving average. The price is clearly below this area. What else are we looking for here? Well, we're looking for that break of structure, and here is that break of structure right there. You can see the price pulled back, pushed down, and it broke the previous structure here, broke the previous structure here. If you're playing wicks, you could play wicks, that's fine. And so let's go ahead and play this out. You can see here price does come back to my area. So we tap into the zone right here, price doesn't close above the zone, and then price pushes down. You already have a trade off of this level right here for about 12 pips. Not a huge move, but again, here we have more and more action here. Let's just continue to see how this plays out, exactly what happens every time we tap into the zone. You can see here it happens many times. Now, basically, you have a trade off of this level, a trade off of this level, a trade off of that level, a trade off of this level. This is an incredible supply zone because every time the price taps into the supply zone, it slams down, taps into the supply zone, slams down. This is an awesome supply zone. Here you might be a little bit worried because we start to come above that moving average, but given the success of the supply zone, I would continue trading this supply zone as many times as possible. Now, you're probably wondering where to put your take profits, your stop losses. Don't worry, I'm going to tell you all about that later in the video, and I'm also going to give you those live trade examples so you know exactly how to do this and how the live markets can kind of shift your expectations of a strategy like this. So let's look at another example. This is an invalid zone. Why is this an invalid zone? Well, if you see, I've marked up the charts right here. You can see this is an area, this is an area, this is an area, right? These are my key levels of support and resistance. Now, what this is showing us is the market is in a range, right? We don't have a clear uptrend. We don't have a clear downtrend. When a market is in a range, it's going to be harder to get good supply and demand zone wins, right? So what we have right here is we have our demand zone. You can see here, I set it up on the red candle right here before the big push up. And this is a nice push up. You know, we do have 1, 2, 3, 4, 5, 6 green candles in a row. We do create some great fair value gaps, right? That's what we want to see on that big push up. But because we're in a range, the likelihood of this holding is lower. And as you can see here, it doesn't hold. It slams right through and you would lose that trade. So you do have to understand the market structure. It's important to understand when you're in a range, when you're not in a range. Like I said before, the EMA, the moving average exponential, can help with this. You could see right here, we are struggling. We are above it, we're below it, we're above it, we're below it. We don't have that kind of clear path. When we get this break above here, you could potentially use this as the demand and would have had a decent trade there. Ideally, you want to be in a clear uptrend, a clear downtrend when you're using supply and demand, or else these choppy markets are going to chop you up, take away your profits. Here's another invalid zone. So you can see here, we have a strong push down right here. We don't get that real break of structure here. You can see this level right here is never broken by the price. So it's not a great setup. What I would be looking for on this one is probably this pattern here. We get the 1, 2, 3, 4. Okay, that's a bit of a better pattern. And we could say that this right here is a recent break of structure. And if we did that, you can see here we've got the green candle. And if we pull this all the way across right here, this actually does end up being a valid supply, and price does tap into that supply and then slam all the way down. So there are these kind of small things you have to look for when setting up your supply and demand zones. And again, this was a weak supply from this level anyways, because you could see we did have buy candles right here, and these candles weren't very aggressive. Look at this wick right here. This wick was telling us there was a bunch of buyers at this level really resisting this price, so that wasn't a great supply zone in the first place. Okay, so you definitely know what's a good zone, what's a bad zone. Now I want to get into the type of entries you can do. If we go into my MetaTrader right here, we click new order, you can see we have market executions. If we go into pending orders, we have limit orders, we have stop orders. I'm going to tell you what is the highest probability, the best way to use these in supply and demand trades. One of the best ways to enter a trade is market execution, right? This is because you can watch the trade live. You can see the price comes, taps into your zone. Because this is the 1 hour, this is going to, you can sit here, you'll start to watch the price come down. It'll give you some time, and you could see this wick in. You could enter off of that level very, very quickly. And because you're there, you're actually watching the reaction live. This is going to give you a high win rate on your supply and demand zone trades. This right here is like a limit example, right? You can see the price right here is coming down. Now, as soon as it hits this level, it's going to trigger the trade. See, what happens here is the price slams down and knocks you out of the trade. There's nothing wrong with using limit orders, but you do have to understand, if you're watching this trade live and the price is just breaking through your zone, you're just not going to place the trade. But if you're not there and the limit order opens it up, it could just smash right through. It could knock you out of the trade. This is why when I trade supply and demand, the most common entry I use is probably the stop order. So on this example here, you can see we've got a big red candle coming down. So we're going, I don't know if I want to trade this, right? But it is starting to wick here. It's starting to get a little bit of resistance. You know, we do have a support line down here, but we really want to see a push upwards. So what we'll often do is set a buy stop. So you can see the candle comes into the zone. Maybe it comes all the way down here, but it doesn't close below the zone. If it closes below the zone, it's invalid. I won't trade it, right? If it wicks below the zone, that's fine. The wick below the zone is fine. Wick into the zone is fine. What I would do here is I would set a buy stop. So what that means is I want to see the price return to this level right here. The candle dips in, and then I want to see a green candle at least get to this level. And at that time, I feel like, okay, the demand zone is pushing us up a few pips here, and then we're getting the reaction that we want. So you can see here when the candle comes up and breaks through this level, it starts the trade automatically. That's my buy stop. And then the trade pushes up eventually to hit my take profit at this level right here. So for me, your best bet when trading supply and demand, you want to have market execution and buy stops. I find those are the most accurate. If you're not at your computer and you really trust your demand zone, you can use a limit order, but I find those are a bit higher risk, lower probability. Now, the next thing I want to show you is momentum, right? Price momentum. What are the candles showing you? You know, we get our huge push up right here. We've got an awesome demand zone. You can see here, we've got the fair value gap, right? An awesome demand zone. But what I really like about this setup is we're getting the price slowing down. Look at the price slowing down as we approach our zone. And then we get the price in the zone. There's a little bit of indecision within the zone. We get a couple of wicks here. Nothing is closing below the zone. And so this is a high win rate setup because we have that slow momentum. Let me show you what happens when we get fast momentum. Look, price slams down, does not respect the zone. That's a low win rate, right? You want to have some green candles in here. You want to have this extend out a little bit like this as it comes towards your zone, and then you're going to get a better reaction because you want to see some buyers coming into the market. You don't want the price just slamming right down. That's going to cost you. Now, I also have to show you where to put your stop loss, where to put your take profit. My stop loss, I generally will just place below the demand zone, right? This is my demand zone right here. This is my stop loss right here. You can put it a little deeper. You could put it here if you want. You could put it here if you want. But generally, I'm just putting it below the demand zone because if the demand zone is broken, I've lost the trade. My concept for the idea was the demand zone. So if it's broken, it's a bad demand zone, and I just have to learn from it. As for my profit levels, my first profit level is always going to be recent price action. So this area right here, you could see the price was struggling at this area, and this is a recent price the price just came back from. So when we tap in, we come back, we look over here, that makes a lot of sense. If you want higher probability trades, you can start looking for fair value gaps on the way down. So you could see we have a fair value gap created right here, 3 candle pattern, and you can see we have another one right here, 3 candle pattern, another fair value gap. So those are areas of market imbalance where the price could potentially come up to. And if we were targeting this one right here, that's a 1 to 5 risk reward ratio. If you're targeting this one right here, that's a 1 to 6 risk reward ratio, and you can open multiple positions. So maybe your first position comes up here, you close it. Your second position, you wait it out, you come back here to close it, and maybe you set your stop loss to break even when you get to your first profit level. I frequently do that in my VIP trading room just to try and keep the risk reward ratio better and keep the overall risk low. Now, the last lesson I want to give you here is on time frames. Let's look at this 4-hour time frame right here. You could see we get a strong demand zone, right? This is awesome. We get an impulsive move down. We have the fair value gap right here. Awesome. A big move down. We can't trade this zone, right? Look at this. It's an awesome zone, right? Price may come back to this zone, but it could take like 3 months for price to come back to this zone. So while it's a great zone, if you're trading 4-hour time frame, you're not going to get trades. What you want to do is come to a lower time frame, right? You could see right here, you don't even have a setup. But if we go down to, let's say, the 15-minute time frame, you actually do get a setup, right? So on the 15-minute time frame here, we have 1, 2, 3, 4, 5. That's a good push down. We have our green candle right here, creating our supply zone right here, and we were in a downtrend. You could see price continues to push down, comes back up, comes slowly, right? Some slow momentum. We tap in. Price pushes all the way down. That's an amazing trade. Now, if you were just trading 4 hours, you never would have got this trade, right? So you do have to come down sometimes from your 1 hour to the 30-minute to the 15-minute, and you're going to get some supply zones, some demand zones on some lower levels, or else you're just not going to get trades. Now, I have a couple live examples I want to show you. These are really, really important to the overall strategy. But first, if you're looking for a place to trade, I recommend you sign up with the #1 broker in the business, Ventura. Low spreads, low commission. This is where I'm placing all my trades in 2024. The link is in the description, and registration is absolutely free. So sign up now, and let's get into these live trades. All right, so here were the live trades that I placed. You could see this one for $20,000, this one for $9,000. Let's start with the $9,000 position, and you can work this with me here, right? We are looking for our demand zone. It's the red candle right here before the huge push up. You could see price pushed up very aggressively, right? We got our break of structure at this level right here. 1, 2, 3, 4, 5, 6 green candles in a row. Very good. We get the creation of a fair value gap from our 3-candle pattern, telling us that we've got this smart money here. The institutions are buying from this level, so it's a level that we like. What happens here? Well, price comes up, it comes down, up a little bit more, comes down, but look how slowly it's coming into our zone, right? That's that low momentum, right? The low price momentum. We get a couple of wicks down here, a couple of wicks down here. The price never closes below the demand zone, meaning it remains valid. What kind of order? I use a buy. I use a buy stop. So I want to see the price break out of the demand zone. So I have my buy stop right there. As soon as the price breaks through it, the price pushes up, smashes my take profit right here, and that's for 85.8 pips, a 1 to 3 risk reward ratio. My stop loss is below the demand zone, and it's also below this wick over here. I could have also put it below this level right here. It would have been even safer, but I felt strong about this position. And as for my take profit, I was targeting this recent price. I could have targeted this price. It would have been safer, but there was a lot of price consolidation here. You could see all of this consolidation, making me feel like the price was likely to reach that level again. And then I had the second trade. This trade was even bigger, and you can do this with me as well. We have our supply zone right here. You could see the green candle right here. We've got 1, 2, 3, 4, 5, 6, 7, 8, a lot of candles. We have our break of structure on this level right here. We have fair value gap at this level right here, another fair value gap at this level right here, telling us that we've got the institutional sellers at this level. So all I want to do is wait for the price to come back to this level, and then I'm thinking about entering my trade. You can see this was a really fast one. It was 1 hour, so not that fast, but it tapped in here. As soon as the price started pushing down, I decided to enter the trade, and you can see it very quickly, over the course of a couple hours, came down, smashed my take profit at that level right there for nearly $20,000 on a huge gold position with a risk reward ratio of 1 to 4. Now, I know there was a lot to take in this video. I went through the stops, the take profits, the momentum, what's a good zone, what's a bad zone, and showed you live trades exactly how I break down the market when I'm trading supply and demand. I hope this longer video helps you with your supply and demand trading career, and I really do believe if you follow all of these rules, you will become a better supply and demand trader. Thanks so much for watching. Smash that like button, subscribe to the channel, leave a comment with any questions you may have. Consider joining my VIP trading room or my free trading room. Links to those are in the description, and I use this strategy in those rooms. Thanks so much for watching. I'll see you next week. Much love.